So today I want to talk about ESG ratings again. I do have some other videos out there talking about sustainable investing in general, ESG ratings in particular. You can watch those videos if you follow these links here. Today I want to think about whether or not these differences in ratings can actually tell us something as an investor. Can we profit given the differences in ratings? As a reminder, here are the 6 big players in the ESG ratings space. They do largely disagree in terms when it comes to a rating. Here's some data there, but you'll find that a company rates well with one rating agency and poorly with another. Pause the video if you need to check out that chart better. The ways that they disagree tend to be on 4 metrics. One is weights. So they just weight the different attributes differently. Turns out this has a small reason why they're different. It's a small reason that's there. Another one is scope. That is that they just looking at a different mix of attributes. That has a pretty big part of why they are not aligning on their total ratings. The biggest one is measurement. They see something, but they just give it a different score. They just disagree on that. Finally, there is some sense of rater bias out there. So even though they're looking at 2 different unrelated metrics, they tend to be correlated across the same company. So there is some bias there. Of course, today the question is whether or not you can profit from this information. Here's some information, some research from research affiliates. They looked at 2 different ESG providers not given intentionally, and said, how do the returns differ? They looked at the United States, they looked at Europe, they basically kind of weighted it based on which companies out there have high ratings. So they looked at the top 86% on a market cap basis, then they took the top 50% of those that had the highest ESG scores and then market cap weighted that. Here we see that in the United States, both of these ESG weighted portfolios underperform the benchmark, albeit with lower volatility. And when it comes to Europe, they both outperformed, again, with lower volatility. So a very nice Sharpe ratio from Europe. But I would caution you from taking this information and investing in this as a strategy. I think you need to have some foundation or merit to why you would do this that would justify, at least conceptually, why these companies should outperform over time. I do have some videos that talk about these kind of dynamics and how you should be thinking about your investments. You can watch those videos if you follow these 2 links here. A paper out there that was recently written goes at this in a different way and says, look, let's look at standard deviation of ESG scores, the ones that are higher, more disagreement, what happens in terms of subsequent returns. Here we find out, looking at the differences here, that yes, on a total basis, there does seem to be some predictability there. Companies that have larger disparities in terms of their ESG ratings have higher subsequent returns, especially true on the environmental side of it. They do adjust this for some common factors out there. So, market capitalization, book to market, general profitability momentum, deviation of earnings analyst estimates, beta, volatility, et cetera. You can see that here. Now, they were saying, look, hey, there is some reason for this, right? So if you have disagreement in terms of ESG, that means there's more uncertainty. The company, therefore, is riskier. Therefore, I'll pay less for it because I demand higher returns to compensate for that risk. Also, interestingly, in a lot of cases, the companies that have the bigger differences are large, unprofitable companies or companies with lower or no credit rating. They also say, wait, well, we did that where the dependent variable was returned. What about if it's volatility? So they look at a few different risk or volatility type measures here. So total volatility, idiosyncratic volatility, et cetera, and said, hey, are there any connections between ESG scores and this? They do see on the social front, there are some significant results there that say, hey, yeah, there is some connection there. You also see a little bit over here kind of in terms of the total score. These aren't huge, but there is a little bit of something there. Ultimately, they say, look, the returns are more associated with the differences than the ultimate volatility associated with those differences. But again, very interesting out there. I do think you need to be careful about taking either of these results and implementing it into a strategy. You need to think about this, what's driving it. Are those returns really significant enough, different enough to justify the risk associated with them, the transaction costs, et cetera. That being said, happy trading out there. I hope you enjoyed that. Thank you so much. I'm Brian Kozlowski.